Hey, this is Patrick with Peterson Accounting and Tax, and today we're just going to touch on some of the changes for the One Big Beautiful Bill going into place in 2025. So first, this is from my tax software, so it's just a summary of the changes. So made permanent by the One Big Beautiful Bill was the Tax Cuts and Job Act tax brackets. So we've had these since 2017. They are 10, 12, 22, 24, 32, 35, and 37% being the highest federal tax bracket. We did have some increases in our standard deduction. These usually go up a little bit each year, but this increase was higher than normal. For our single folks, that's from up to $15,750, a change of $1,150. So if you're making about $75K, that should save you about $392 there. For our married filing joint, that's an increase to $31,500, an increase of $2,300. So a family that makes $125,000 should see a savings of about $440 there. The seniors usually get a increased standard deduction higher than normal. For those 65 plus, it's going to be $2,000 more than single or head of household. For married filing joint, $16 apiece, up for $3,200 for both. We did have some pretty unique changes this year. A seldom used tool in the form of above the line deductions. These actually act as kind of like an adjustment to your modified adjusted gross income rather than a deduction taken on Schedule A, like mortgage interest or charity or medical. Or that something we're going to talk about pretty soon is the state and local tax deduction. So those are on Schedule A. You need to itemize to get benefit from those. For above the line deduction, it doesn't matter if you itemize or take the standard. Everybody benefits from it if you qualify and you are not phased out at your income level. So for senior 65 plus, you get an additional $6,000 tax free. So savings at $75,000. So the top end of that bracket for singles is about $1,320. The max benefit for married filing joint at that 150 is roughly $1,440. So some hopefully good savings for our seniors out there. And part of the core of the One Big Beautiful Bill where tips and overtime not free, but that was never going to happen. So the first $25,000 in tips, essentially you get tax free, phased out when you make 150 single or 300K or more. And phase out, that means as you exceed that number, the credit gets reduced. So if you make 150K and you did have $25,000 in tips, that could be savings of up to $6,000 for you. Overtime, you can do it twice, up to $25,000, but for a single filer that did get over $12,500 pay of overtime, will save about $3,000 here. I believe overtime is going to be reported differently on the W-2, so we'll see how that change rolls out. We also have car loan interest. So we lost some the EV credits, but we have this instead. So this is only for new car loans with vehicles that had final assembly United States, and it's the interest on those loans up to $10,000, phased out at 100K single, 200K married. Probably not too many people getting the benefit from that, but if you did max out, the benefit, it should be maybe something like $1,200 to $2,200 in savings, something like that, depending on your situation, if you max out the credit. Speaking of credits, we have a few credit changes. So we have the adoption credit. I think it got a slight increase, but what's important is $5,000 is now refundable. For those who don't know, refundable means that if the credit pays for all of your tax liability, whatever is left over can come to your pocket in the form as a refund, as opposed to non-refundable. So usually get a lot of credit for adoption, and you can't always get the benefit from all of that credit. So now, if you did get the max benefit, paid off all your tax liability for that credit, and you have some left over, up to $5,000 can come to your pocket in the form of a refund. So we like that. Child tax credits did go up to $2,200. All my parents love and know this. So child tax credit is a non-refundable credit. If you don't get the full benefit of the child tax credit, you can get the additional child tax credit, which is a refundable credit. So you can't get the full $2,200 per child back to your pocket, but maybe up to $1,700 depending on your situations. And all EV credits are gone as of the end of September. We have just a few other changes to touch on for the individual. So SALT is state and local taxes. So this is going to be sales tax, property tax, state income tax, and a few others. But it was previously capped at $5,000 for individual or $10,000 for married, filing joint. So getting this up to $40,000 in 2025 is beneficial for people that may have bought a new vehicle, pay a lot in state income tax, have high property taxes. So this should benefit a lot of people all the way around. It gets adjusted for inflation for the next 10 years, I believe, resetting down to $10,000 in 2035. And this is not a above the line deduction. This is going to be on Schedule A. Educators, yeah, they get an adjustment. It used to be $250, now it's $300. So we probably need to add a zero on that, in my opinion. And something a little controversial is the estate and gift tax. So these pretty much doubled. So it probably doesn't apply to me or anybody I'm talking to, but if it does, hey, good on you. You can now, pass on a lot more of your money tax free. This is an interesting change, the reporting requirements for the 1099K. 1099K is usually what you get from like credit card processors, and it tells you how much cash went through your credit card machine. But what a lot of people didn't know is that the reporting thresholds have been getting smaller and smaller for the 1099K, and many people were going to receive this from Cash App or Venmo or Zelle or any of those other person-to-person transferring apps. So I think with this change, the new threshold being 20,000 and 200 transactions, I think only maybe 1/1000th of the reports of the 1099Ks are going to have to go out as opposed to the other reporting thresholds. That's a wild estimation, but it's going to be a significant change. And the last big thing we want to talk about is the Trump account. So for children born from 25 to 2028, if you open one of these accounts after July 4th, 2026, which I think is the 250th anniversary of the signing of the Declaration of Independence, the government will put $1,000 in this account. And this account is going to be like a investment account, kind of. You can contribute to it as long as the child is under 18. The parents have custody of the account, and then 18, the child takes over. You can no longer contribute to the account, but you can withdraw from it with a 10% penalty before you're 59 and a half. But if you wait the whole time, the growth is going to be tax free. So you can only contribute when the child is under 18. No benefit for the contributions. You do pay a 10% early withdrawal penalty for distributions before 59 and a half. But if you wait, everything is tax free from the amounts you put into the growth. For my self-employed people, do know that bonus depreciation is back in a big way. So ask about that at your local representative. If there's something else you want to talk about, or if you got questions, comments, or concerns, leave me a message below. Reach out to me at my website, www.petersonaccountingandtax.com. Thank you for your time.